Hello, welcome to The Truth Revealed, Seven Pillars of Financial Freedom, a Wealthy Approach. Today, we're going to be unlocking the secrets of financial empowerment. So, welcome to this opportunity to embark upon financial independence. Today, we take a journey, one that charts a course through the often complex and turbulent waters of personal finance. As we set sail, our compass is guided by a powerful acronym, WEALTHY, representing the seven fundamental pillars of financial freedom. Now, this compass isn't just a tool, it's a beacon of enlightenment in the foggy realm of financial planning. It illuminates our path with W, wisdom in planning, ensuring our voyage is charted with knowledge and informed decision making. Our journey demands that we examine alternatives, casting a wide net to explore all investment horizons beyond the traditional landscapes of stocks, bonds, and mutual funds. It's about enriching our portfolio with diverse investments like life insurance products, unlocking new dimensions of financial security and growth. Vigilance is our watchword, as awareness of pitfalls highlights the hidden dangers that lurk beneath the surface, excessive fees, the quagmires of debt cycles, and the mirages created by unreliable financial advice. These are the sirens of the financial sea seeking to lead us astray. Yet, armed with knowledge and insight, we navigate these waters with discerning eyes. L, leverage insurance products as our stalwart defender on this voyage, showcasing the strategic use of life insurance products not merely as a safeguard against unforeseen storms, but as a versatile vessel for navigating the currents of financial planning. It offers us living benefits, avenues for cash value growth, and mechanism for estate planning, transforming our journey to one of empowerment and foresight. The winds of T, transformed thinking, fill our sails, urging us to question the prevailing currents and winds of the financial industry's narrative. It's a call to empower ourselves to seek out our own courses that lead to true financial liberation, charting territories that resonate with our personal aspirations and dreams. H, harness opportunities, reminds us the sea of finance is ripe with prospects waiting to be seized through the tactical use of financial instruments like Index Universal Life, also called IUL. Policies and annuities, we anchor our financial future in stability and growth, mastering the waves of opportunity and securing our place in the harbor of prosperity. And lastly, why? Yield empowerment is the star by which we navigate, emphasizing the active engagement and empowerment in our financial journey. It heralds the role of continuous learning, adaptation, and proactive stewardship of our finances, ensuring that with each day we draw closer to the shores of financial freedom and security. So as we venture forth, let this wealthy compass be your guide, steering you toward a future where financial freedom isn't just a distant dream, but a tangible reality. Welcome to the beginning of your journey to financial freedom. So I want to thank you for joining us today. And before we get into the heart of our presentation, I'd like to share a few important instructions to help you get the most out of this session. First, highly encourage you to take notes through the presentation. There's going to be a lot of valuable information, and jotting down key points can help you remember and reflect on what we discuss. Second, I'm sure many of you will have questions as we go along. I kindly ask that you write down your questions as they arise. After you've completed watching this video, you'll have an opportunity to meet with me, Carlos Millsap, at no cost to get your questions answered, and even if you want a little bit more information. So, okay, we're going to go ahead and get started. So take a moment to ensure that your devices are on silent mode, the TV's off, etc., to minimize any of your distractions and get comfortable. Thank you for your attention, and let's get ready to begin. So let me tell you a little bit about me, your expert, your wealth building strategist, Carlos Millsap. See, I am a seasoned financial expert with nearly 4 decades of experience in the finance industry of some sort. Over the past 14 years, I've been specializing in financial products like life insurance products, um, in the life insurance sector, helping my clients obtain and retain wealth using safe and effective life insurance products. I've been committed to my clients' well being and needs without wavering, as evidenced by my dedication to ongoing training and professional development. By staying up to date on the latest trends and best practices ensures that I can provide the highest level of service to those who trust in me with their financial well-being. Beyond my expertise, I'm known for my caring and empathetic approach to my work. I understand that every client has unique needs and goals, and I take the time to listen to uh, their concerns and aspirations. This personalized approach, combined with my in depth knowledge of the industry, has earned me a reputation as a trusted advisor and partner to my clients. Now, whether you're just starting to plan for your future or you're looking to enhance your current strategy, I hope to be your trusted partner that you need and who you can count on. Now, with my expertise and my team of industry's brightest minds, we take a personalized approach and an unwavering commitment to your success. We will help you achieve your goals and secure your financial future with confidence as we put your needs first. Now, what if I told you that the financial system is designed not to enrich you, but to maintain your status as a perpetual customer? They literally tell you what to think about certain things without you knowing it. They know that they can get you to think a certain way and you will not even question it. And this helps them get richer. Let's take a look into something that's been on my mind and maybe yours too. You ever get the feeling that the whole financial system is set up more for keeping us in check rather than setting us free? It's like everywhere you turn, there's another scheme or product designed to keep us on the hook, spending our hard-earned money and staying just behind. Well, let's get real for a moment and unpack something that's been happening right under our noses. We've all been nudged gently uh, but persistently into a financial comfort zone that's lined with stocks, banks, mutual funds, mutual municipal bonds, 401ks, and IRAs. These are the tools we've been told time and again are our best bet for financial security and comfortable retirement. It's like we've been given a map, but it only shows one road. But here's the kicker: while we're walking that road, there's a whole network of paths we're not seeing. Life insurance products is one of those paths. It's often shrouded in fog, not because it's less valid, but because it doesn't fit the narrative that we've been fed. So let's go ahead and talk about the elephant in the room. You saw this a few screens back. Brainwashing. It might sound strong, but think about it. How else can we describe a system that shapes our beliefs and decisions so subtly, so thoroughly, that we end up doubting anything outside of it? This isn't about selling you a life insurance product. No, this is about challenging you to question the status quo that financial institutions have crafted. They built a system that where your money works wonderfully for them, not for you, for them. You take on the risk, invest your savings in their products, and if you're lucky, you see a return. And guess what? They make money from your money, whether you do or not. You pay a fee for assets under management. Meanwhile, they use your money to play a bigger game, one where the stakes are higher and the returns are richer. Now, pause and ask yourself, does that seem fair? Consider this. Every time you contribute to your 401k or an IRA, you're locking your money to a system that benefits from your participation, doesn't necessarily prioritize your gain. Sure, these are valuable tools for retirement planning, but are they the be all to end all? No. These institutions have become the gatekeepers of our financial well being, but at what cost to us? Now, the pushback against life insurance products as a viable part of your financial strategy is a prime example of this brainwashing at work. It's not just about the death benefit, it's about the potential for living benefits, the ability to build cash value, and having another source in your financial toolkit. Yet, we're led to believe it's too complex, it's too risky, simply unnecessary, too expensive. Why? Because it's a path less traveled, less talked about, and less understood. Thanks to the narrative that's being crafted for us, we're not just passive players in this game. It's time to recognize that we've been conditioned to think within a box, to follow the path that's been laid out for us without questioning where it leads or who it really benefits. It's time to widen our view, to educate ourselves beyond the mainstream narrative, and to make informed decisions based on a full spectrum of options. This is your call to action, not to blindly accept what I'm saying, but to challenge the information you've been given. Look around, do your own research, and think critically about where your money is going and what it's doing for you. Is it really working in your best interest, or is it serving a system designed to minimize your gains while it's maximizing its own? The financial institutions have had their turn at the wheel. It's time for you to take control, to question, to explore, and to decide for yourself what fairness in finance looks like. Does sticking to the prescribed path seem fair, knowing what you know now? Does the question only you can, those are questions that only you can answer, right? Think about it. The system's got all these ways to make sure they're getting a piece of your pie while you're left figuring out how to make that pie last. They got credit cards and debt and that debt trap. Here's the deal. Credit card companies, they're not just in the business of convenience, giving you a card for your convenience. They're in the business of debt. They lure us in with points, miles, you name it. But then, bam, you miss a payment and suddenly you're drowning in interest. It's like they're betting on us to fail. Now, let's talk about the mortgage maze. Then, then there's the dream, right? Own your own home. But check this out. Those 30-year mortgages are front loaded with interest, a lot of interest. So we're just feeding the banks for years before we even start really owning our homes. It's the long game, and they're holding all the cards. They know that the average lifespan of a loan is only 7 years. So that's why they front load to get all the interest in the early years. So what happens in 7 years? People either sell or refinance, and the mortgage company will now be able to get even more interest out of you. It's a vicious cycle. And let's talk about these investment fees. They're eating your lunch. And don't get me started here. You think you're making a smart move, saving for the future, but then you realize your returns are getting nibbled away by fees you didn't even know existed. John Bogle, the Vanguard guy, he was onto something with those low cost index funds, trying to flip the script on the whole industry. Now, when it comes to financial advice, it pays them, but not you. You ever notice some financial advisors push certain products like they're going out of style? That's because they're often getting a cut. It's not about what's best for you, it's about what's best for their wallet. And when they fought against the rule that would make them put our interests first. That told us everything that we needed to know about them. Now let's talk about the 401k switcheroo. Now the 401k, this is what people don't know. Um, it could be a great thing for savings, retirement, right? But what it really did was shift the burden off of our employers and onto us without making sure we knew how to handle it. The 401k was supposed to be the third leg of a three-legged stool with our pension, your Social Security, and then your 401k. But companies found a way to make people think that saving your own money was a great benefit. Well, Ted Benner, the guy who came up with this whole thing, he even says it turned out into something he never intended. So, what's the takeaway from all this? It's like the deck is stacked against us, but that doesn't mean we can't play the game. We just got to be smart, educate ourselves, and not fall for the okie doke. It's about making moves that benefit us, not just lining the pockets of the big guys. Let's keep our eyes open and our wallets closed, and at least until we know the game that we're playing. So we're going to shift gears a little bit now and really get into some weeds. Let's talk about the big players, the billionaires, the banks, corporations, and how they navigate this financial maze that we've been talking about. You see, they play the game differently. While many of us are out here getting tangled in debt and dodging financial pitfalls, these folks are using life insurance products in savvy ways to keep control of their money and make more of it. You see, I talk to some people say, well, I'm not a billionaire. I don't have all that money. What about the poor people? Well, if you want to stay poor, keep on doing what you're doing. This is all about positive arbitrage and eliminating what's called lost opportunity cost. So let me break this down. See, when it comes to strategies, and sometimes people think it's a big secret, but it's really not a secret at all. It's all about it's about using cash value life insurance, like whole life insurance, index universal life insurance policy, as a financial tool. These aren't your typical life insurance policies that just pay out when someone dies. No, these policies have a cash value component that grows over time, tax advantaged, and can be accessed during the policyholder's lifetime while they're still living. But this could be a secret weapon. The biggest secret weapon of this is positive arbitrage and eliminating lost opportunity costs. So here's what positive arbitrage is. It happens when you borrow money at a lower interest rate and invest in something that yields a higher return. So with cash value life insurance, policyholders can borrow against the cash value of their policy at low rates, then take that money and invest that money in something in higher yielding opportunities. Now they're getting interest in both places. They're essentially using the life insurance company's money to make more money. Lost opportunity cost refers to the money you lose when your capital is tied up and not earning a return. By using life insurance as a financial tool, these savvy investors keep their money working for them constantly, avoiding lost opportunities. They have their money working in two places at the same time, the same dollar. So who's doing this and how? I'll tell you who's doing it. You have banks and bowling banks, which is Bowling Bank on life insurance. What they do is they fund employee benefits, improve their bottom line by using this. The cash value of these policies grows tax deferred, providing banks with a lucrative investment vehicle. Corporations and COLI, similarly, corporations use COLI or corporate owned life insurance to ensure key executives, they to ensure them that they are able to keep key executives, excuse me. They leverage these policies, the cash values for various financial needs, benefiting from the same growth and tax advantages. Now, billionaires and estate planning, here's how you use this. Wealthy individuals, they often use life insurance for estate planning by placing policies in trust. If you ever get a chance, look at what the Rockefellers did. Now, what they can do is they can provide heirs with tax-free benefits, protect their assets, and ensure that their wealth is transferred efficiently and privately. So do you want to do like the rich do, or you want to do like the poor do? Okay. If you want to keep on getting what you're getting, keep on doing what you're doing. Now, here's some other benefits. Tax advantages. The growth of cash value in these policies are tax deferred. And if managed correctly with using policy loans, you can pull money out tax free. That's right, without being taxed. You also get financial control. Policyholders can access the cash value through policy loans without penalties or age restrictions, offering financial flexibility. What does that do for you? It allows you to get uninterrupted compound interest on your money. And we're going to talk about that a little bit more. You're using other people's money and not your own. Estate planning. Life insurance can provide a tax efficient way to transfer wealth from generation to generation. We're talking about generational wealth here. And that's very important. That's biblical. So while many of us are navigating the financial maze, trying to not to get caught in traps, the big dogs are using tools like life insurance products not to just avoid the pitfalls, but to build wealth in their journey. It's a powerful reminder that knowledge and strategy are key to financial success. By understanding and applying the strategies of the wealthy, we too can start to take control of our financial destiny. Okay. Let me give you a little history here now in regards to life insurance company. Let's take a little journey back because I want to make sure people understand that this is nothing new. You see, this whole life insurance thing when it started, picture us being in the late 17th century, and ship owners are just kicking back in coffee houses, just like they're at Starbucks or something, but with a lot more at stake than just a cup of coffee. These folks, these people, they were beginning to lay down the groundwork for what we now know as life insurance, agreeing to look out for each other. And if one of their ships sank, it was all about spreading the risk so no one person got knocked out by a single bad wave. So it went from saving coins to growing wealth. Now fast forward a bit, and life insurance isn't just about making sure your family's taken care of when you're not around. By the 18th century, companies like the Society for Equitable Assurances of Lives and Survivorship began around 1762. They started offering policies that let people stash some cash, growing their money while they're still breathing, while they're still alive. Now, this was way before the stock market game came along, and they were beginning to grow their wealth using life insurance. So life insurance was there, was where it was that where folks were looking to save up money and see their money expand. So now let's look at banks versus life insurance. When we talk about where's it safer to park your money, life insurance companies have been holding it down way before and way better than banks. Over the last quarter of century, banks have been dropping like flies compared to life insurance companies. We're talking about the FDIC stepping in on hundreds of banks, especially during those rough patches in the 80s and the late 2000s. Life insurance companies, though, on the other hand, they've been steady thanks to tight rules and conservative approach to how they handle their business. Life insurance companies are highly regulated. They're held to a higher standard than banks. So how banks and life insurance companies stack their money, banks play this game called fractional reserve banking, where they only keep a little bit of the cash that's deposited, like just 10% or so, and then lend out the rest. It's all good until you got a whole bunch of people that's coming to the bank and they want their money at the same time. On the other hand, life insurance companies, they've got to keep enough reserves to cover what they promised the policyholders, making them a lot more stable and reliable. They have to have higher cash reserves. Now, when it comes to the life insurance world, you've got two different types of insurance companies. You have mutual companies and stock companies. So mutual life insurance company and stock insurance companies. Mutual life insurance companies, these are the ones owned by the people holding the policies. If the company does well, policyholders might see some of the love in the form of dividends or cheaper premiums. It's like being part of a club where everyone's looking out for each other. Now, stock life insurance companies, these are the ones playing the stock market game. They're owned by shareholders out to make a profit. They're under pressure to keep those profits high, which can sometimes mean they're looking out for the shareholders first and foremost. So there you have it. Life insurance started from humble beginnings with ship owners covering each other's back to becoming a key player in the lives of many people for financial strategies. It's not just about leaving something behind for your family. It's also about making smart moves with your money while you're here. And when it comes down to it, life insurance companies have been holding it down, holding down the fort in ways banks can't match, making them a solid choice for keeping your financial game strong. So the value of life insurance industry, when it comes to the world of life insurance, let's break it down what's really going on in this industry. You see, life insurance isn't just a part of the financial game. It's a major player with some serious numbers back it up. The big picture on life insurance is this. When we're talking globally, we're talking about an industry that's raking in over 2.9 trillion in premiums a year. That's trillion with a T. And right here in the United States, the life insurance market is sitting on a mountain of assets valued at around $8 trillion. And the government is in over $30 trillion worth of debt. Yeah, you heard that right. Now that it's a massive chunk of the economy we're talking about when it comes to what the life insurance company is holding in assets. So when we talk about life insurance, who's covered and who's not? Now, when we peel back the layers, we find that about 54% of Americans have some form of life insurance. That's a little over half of us taking steps to protect our families and our futures. But flip that coin, and you'll see nearly half of the population is rolling without any coverage. That's a lot of people leaving their loved ones their loved ones' financial security up to chance. The real talk on term insurance. Let's talk about term insurance for a minute. It's straightforward. It's no frills kind of life insurance, and it covers you for a set period of time. But here's a kicker. Less than 2%, listen to me, less than 2% of these policies ever pay out. Why? Because most people outlive their policies. It's like buying peace of mind for a while, but in the end, the odds are you won't need it. You won't ever cash it out. That's why it's cheaper compared to other types of insurance. It's all about protection without the bells and whistles of an investment savings plan. So what's the takeaway from all this? The life insurance game is huge, with trillions on the table and a significant role in our financial lives. Yet there's a big gap in coverage, with too many people not taking advantage of what life insurance has to offer. And when it comes to term life insurance, it's an essential part of the mix, especially if you're looking for a budget-friendly way to give your family the huge financial safety net, even if the chances of it not paying out are slim. The bottom line, it's all about making informed choices, whether you're looking to protect your family's future, save for the long haul, or just keep your financial bases covered. Understanding the ins and outs of life insurance is key in having a good financial advisor in life insurance is paramount. And remember, it's always a good move to chat with a financial advisor and get the lowdown on what makes the most sense for you and for yours. Now, when it comes to this life insurance, first off, the general vibe around life insurance is that it's something you get because you have to, not because you want to. It's seen as a necessary evil, something to check off the adulting list. A lot of people view it as morbid, paying money on the off chance you die unexpectedly. It's not exactly a conversation started at parties, right? Plus, there's this perception that it's just too complex or it's too expensive or too too expensive to bother with or that it costs so much and The agents make so much money in commission, and especially amongst younger folks who think they're invincible. Cash value life insurance, the misunderstood player. Now, when we shift gears to cash value life insurance, that's where the confusion really ramps up. We're talking about whole life, universal life insurance policies, index universal life insurance policies that not only provide a benefit, but also have a savings component that builds cash value over time. Here's the thing, many people don't even realize these options exist or how they work. They hear life insurance and think it's all the same flavor. But what is it? But why is that? Well, for starters, cash value life insurance is often seen as a more complex cousin in the life insurance family. It comes with higher premiums than term life insurance. And for a lot of people, that's a deal breaker right there because they don't understand it. They're thinking about the here and now, not necessarily planning for the what ifs down the line. Then there's the whole investment aspect. They're thinking they're investing, but they're not investing because investment means you're taking a risk. The idea that you can use life insurance as a financial tool for wealth building is pretty foreign to a lot of people. It's not something that's taught in schools or talked about at the dinner table or talked about in the barbershop or the beauty shop. And let's be real, it's not often discussed anywhere. The financial literacy gap plays a big role here. If you're not in the know, how are you supposed to take advantage of these tools? So the perception issue boils down to a few key things: lack of awareness, complexity, and a focus on immediate cost over long-term benefits. And let's not overlook the trust factor. With all the fine print and the stories of denied claims, people are skeptical. They're wondering if they're putting their money into something that will actually pay off for their loved ones, or if they're just lining the pockets of big insurance companies. So we're trying to change the narrative here. So, so how do we shift these perceptions? Education is key. We need to start talking about life insurance, including life insurance, or including cash value life insurance and all life insurance products in a way that's relatable and understandable. It's about showing people not just the protective aspect of life insurance, but also its potential as a financial planning tool. And for those of us in the know, it's on us to share what we've learned to break down the myths and highlight the benefits. In the end, it's about making informed choices. Life insurance, especially cash value life insurance, can be a powerful part of a broader financial strategy. But until we bridge that knowledge gap and tackle the misconceptions head on, it'll remain one of those underutilized tools in our financial toolkit. So there's two types of life insurance policies, okay? Let's take a look at this whole life insurance thing because let's face understanding life insurance is kind of like mastering golf. You've got a lot of different clubs in your bag for different situations on the course. Just like in golf, when it comes to life insurance, there's no one size fits all. You wouldn't tee off with a putter and you're not going to try to go out of the bunker with your driver. Each tool, or in this case, each policy has its purpose, depending on what you're trying to achieve. So there's two main types of life insurance. We've got the main players in life insurance game, which is your term life insurance and your permanent life insurance, which includes types like whole life insurance, universal life insurance, index universal life, so on and so forth. Then you have term life insurance. It's like your driver. It's straightforward and powerful for long distance coverage, but only for a specific period of time or term. This could be 10, 20, or 30 years. It's there to give you a solid safety net at a lower cost, making sure your family's financial needs are covered if you're not around to provide. But once that term is up, so is the coverage. No more, no less. It's perfect for people looking for a a low cost, effective way to protect their family during those crucial or critical years, like while their kids are growing up or they're paying down a mortgage. they're still working, that's what that's good for. And when it comes to permanent life insurance, which includes your whole life insurance, your universal life, your index universal life, it's more like having a versatile set of irons and wedges. These policies are in it for the long haul, covering you for your entire life. Not only do they provide a death benefit, but they also have a cash value component that grows over time, kind of like a savings or investment account. You can borrow against it. You can use it to pay premiums or even cash it out under certain circumstances. Uh, so now people think it's more expensive, but what you're doing is you're actually putting more money into it for your cash components so you can have a safety net. It's a financial tool in your bag. So choosing the right club, I mean, the right policy depends upon or deciding between whether you want to do term or permanent life insurance depends on what you're trying to achieve, your financial situation, and what stage of life you're in. It's about asking the right questions when you're trying to get a policy, or someone asking you the right question. Are you looking for protection for a certain period, or do you want something that you can contribute to your financial strategy over your lifetime? If you're just starting out, maybe all you need is that driver, that term life insurance policy to cover the basics. But as you get more sophisticated, as you start building wealth, or you want to leave a legacy, you might start looking at those irons and those wedges. Permanent life insurance, they round out your financial strategy, just like in golf, where you select your club based on the shot you need to make. The type of life insurance you choose depends on your financial goals and needs. There's no one size fits all answer. It's about having the right tools in your bag, knowing when and how to use them. Even in golf, you need a golf pro. In financial services, you need a financial pro. And so you need that financial pro to look over your game plan. A financial advisor can help you pick the right clubs for your life insurance needs, making sure you're covered for all the financial fairways and bumpers life might throw your way. Cash value life insurance. Okay, let's go a little bit deeper now when it comes to the world of cash value life insurance. And let's unpack something real quick here. It's not just a financial chessboard, but it's a powerful queen that can move in multiple directions, protecting your kingdom while advancing your position. When we talk about putting your money in smart places first, cash value life insurance shines bright for a few key reasons. And one of those reasons is the magic of uninterrupted compound interest, especially when it comes to those tax-free policy loans. So the power of cash value life insurance, including whole life and index universal life and universal life policies, is like having a financial multi-tool in your pocket. It's got layers. On one level, you've got the death benefit offering peace of mind that your loved ones will be taken care of. But then there's this whole other level where your money is growing tax deferred inside the policy. That means the IRS isn't dipping into your growth every year, letting your letting your money build up more muscle over time. So you need to learn how to step up your game with uninterrupted compound interest. This is a place where you put your money first before you put it somewhere else. Now here's where it gets really interesting. The concept of uninterrupted compound interest. This is a game changer, people. I hope you hear me. It's a game changer. When you take out a policy loan against the cash value of life insurance, you're not pulling your money out. Hear me. Instead, the insurance company is giving you a loan using your cash as collateral. Your cash value continues to earn interest as if you didn't touch it. This is why we say the compound interest is uninterrupted. Your money keeps growing, working hard for you, even while you're using the insurance company's money for whatever you need it for. So here's some more depth to it. These tax-free policy loans, these loans are a standout feature because they're tax-free. You're not getting taxed on the money you borrow, which is a sweet deal compared to pulling money from other investments accounts where you might get hit with taxes and penalties. And the power is the uninterrupted growth. The uninterrupted compound interest means your cash value keeps growing without taking a break, even when you borrow against. It's like having your cake and eating it too. You get to use the money for whatever life throws your way or opportunities that you want to grab. And you get the same dollar working in two places at the same time, all while your original investment continues to compound and increase in value. It's powerful, people. Financial flexibility and security. This setup provides a unique blend of flexibility and security. Your principal is protected from market volatility, and you have a safety net that's continuously growing, providing a stable foundation for your financial strategy. Enhance wealth building. Over time, the power of uninterrupted compound interest can significantly enhance your wealth building strategy. It's a way to leverage your assets to meet current needs or invest in new opportunities without derailing the long term growth of your savings. Bringing it all together, in essence, cash value life insurance is like having a Swiss Army knife with an added feature, a tool that not only protects but also grows your wealth with a kind of efficiency and flexibility that's hard to beat. The uninterrupted compound interest aspect, especially when tied to tax-free policy loans, is a sophisticated financial strategy that keeps your money compounding and growing no matter what moves you make with it. It's a strategy that demands consideration for anyone serious about building and protecting their wealth. And always navigating these waters is best done with a seasoned professional by your side, someone who can guide you through the intricacies of cash value life insurance and ensure that your financial strategy is as robust and effective as possible. So by now, you should be asking the question, why isn't this not more widely known? It's a number of factors uh, for the lack of widespread knowledge. One possibility is due to its complexity uh, or the misconceptions of the misconceptions of complexities. So let's get into why cash value life insurance isn't on everyone's radar like it probably should be. You see, there's a bit of disconnect in the financial world about this, and a lot of comes down to the narratives pushed by people in the stock market game and the big names and personal finance. First off, the stock market, it's like the main stage where everyone's attention is directed because it's sexy. I got a financial guy. My financial guy told me to do this. It sounds good. Stockbrokers and financial advisors, many of them who are trained with a heavy focus on stocks and mutual funds, often steer their clients towards these options. You should be asking why, because that's their bread and butter, or should I say their Bentley and beach houses. You know, they know stocks inside and out. But let's be real, they make their money through buying and selling of these investments. Cash value life insurance doesn't quite fit into their playbook, mainly because it doesn't offer them the same kind of commission or the ongoing management fees that stocks and mutual funds do. So misconceptions and misinformation. You got uh, big names like Dave Ramsey and Susie Orman. They've got massive following, and when they speak, people listen. The issue here is that they often paint cash value life insurance with a broad brush, calling it a bad investment due to its higher upfront costs compared to term life insurance or directly investing in stock market. They argue that the costs outweigh the benefits, pushing the mantra of buy term and invest the difference or buy term and invest the rest. But here's where the story gets twisted. Their advice is primarily aimed at a broad audience, many of whom may better be served by you know I'm trying to come up with the words that I'm trying to make sure that you guys understand this. But their advice basically from folks like Ramsey and Orman is generally targeted towards individuals who are just will follow anything that they say. The people that who are not going to do their own research, that's going to regurgitate anything that a Susie Orman or a Dave Ramsey say. There are people that are not going to do their own research. But let's take a look. Let's take a quick look backwards. Years ago, there was a company called E.F. Hutton, and E.F. Hutton they had an approach to cash value life insurance that was a fascinating chapter in the history of financial services because they were, in the financial services industry. They were stockbrokers or brokers. Now they began to showcase the power of innovative thinking, and they even made an impact on regulatory challenges. E.F. Hutton was a big brokerage firm, and they remember for their iconic commercials with the tagline, "When E.F. Hutton talks, people listen." However, what many people do not realize is that at one point, their discussions weren't just about stocks or traditional investments. They were also about the strategic use of, that's right, cash value life insurance as a financial tool. E.F. Hutton's innovative approach to cash value life insurance in the 1980s, E.F. Hutton made waves by promoting the use of cash value life insurance, specifically universal life insurance, as a means of tax advantage wealth accumulation. Unlike the typical focus on life insurance as merely a death benefit, E.F. Hutton's strategy highlighted the investment potential of these policies, emphasizing their cash value component that grows on a tax deferred basis. This approach was groundbreaking because it opened the public's eyes to the dual purpose nature of life insurance as both a protective measure and a savvy investment strategy. Now, E.F. Hutton, they had a legal challenge, but they also had a victory when it came to the promotion of cash value life insurance as an investment tool, because it caught the attention of regulatory authorities, leading to legal challenges. But the crux of the issue was whether promoting life insurance as a primary investment vehicle was misleading or constituted as an improper use of the product. In court, E.F. Hutton defended its stance, arguing that the policies indeed offered significant tax advantages and investment potential in line with existing laws and regulations. The outcome was a victory for E.F. Hutton, affirming the legitimacy of their approach to marketing cash value life insurance. That's right, a stockbroker marketing life insurance products. This legal battle, however, underscored the firm's innovative use of financial products and solidified the place of cash value life insurance as a personal tool in financial planning. But this made an impact on tax laws. The controversy and subsequent legal scrutiny surrounding E.F. Hutton's practices prompted a closer look at the tax laws governing cash value life insurance. In response to the growing use of life insurance as tax advantage investment vehicle, the IRS and Congress moved to tighten the rules to prevent potential abuse. This led to significant changes in the tax treatment of cash value life insurance, culminating in the passage of the Technical and Miscellaneous Revenue Act of 1988, also called TAMRA, following the earlier Deficit Reduction Act of 1984, or DEFRA, and the Tax Equity and Fiscal Responsibility Act of 1982, also known as TEFRA. These laws introduced new guidelines and restrictions on the amount of money that could be invested in cash value life insurance policies and still receive favorable tax treatment. Specifically, they established the 7-pay test under TAMRA, which limits the amount of premiums that can be paid into a policy in its first 7 years to prevent it being classified as a modified endowment contract. Policies classified as MEX lose some of their tax advantages, such as tax-free loans against the policy's cash value. IRS codes governing cash value life insurance, the IRS codes that are pivotal to understanding the tax treatment of cash value life insurance include Section 7702, which defines life insurance for tax purposes and sets forth the guidelines for tax treatment of life insurance contracts. Section 7702A establishes the criteria for life insurance contracts to be considered a modified endowment contract based on the premiums paid into the policies. So now these sections, along with the regulations stemming from TEFRA, DEFRA, and TAMRA, form the backbone of the current tax laws affecting cash value life insurance, ensuring that while these policies remain a valuable tool of financial planning, they also are used within the framework intended to balance investment potential with the primary purpose of insurance protection. It always has to look like a life insurance policy. So the story of E.F. Hud and their engagement with cash value life insurance is a testament to the evolving nature of financial products and the ongoing dialogue between the financial services industry, regulatory bodies, and the law. It highlights the importance of innovation and the challenges of regulatory compliance and the lasting impact of legal and tax policy decisions on financial planning strategies. Okay, let's dive into some fascinating stories about people who leverage cash value life insurance in ways that might just surprise you. You see, this isn't just about stashing cash for a rainy day. It's about making or being having the ability to make strategic moves that could change the game forever. Now we're going to see that there's some big names where it changed their lives, changed and even affected us. And trust me, these aren't your everyday success stories. They're tales of foresight, financial savvy, and sometimes sheer survival. So you probably have heard the name Babe Ruth, the Sultan of Swats, financial home run. Babe Ruth, the legendary baseball icon, wasn't just hitting home runs on the field, he was making smart plays off it too. Now, during the Great Depression, when the economy was down and out, Ruth had his cash value life insurance to fall back on. While others were struggling, Ruth's policy allowed him to maintain his lifestyle. It's a testament to thinking ahead and protecting your assets, no matter how invincible you might seem. So his policy endured the depression. J.C. Penney, from department store despair, James Cash Penney, the founder of J.C. Penney department stores, found himself in financial distress during the Great Depression. Penny used his cash value life insurance policy to keep his business afloat during those tough times. It's a story of resilience and the role that strategic financial planning can play in overcoming adversity. Now, Walt Disney, he was dreaming big, and he dreamed big with life insurance policies. Walt Disney, the man who brought us Mickey Mouse and Disneyland, he faced rejection and financial hurdles like you wouldn't believe. When he needed money to finance Disneyland, banks turned him down. They turned him away, not seeing his vision that he had. But Disney didn't let that stop him. He turned to his cash value life insurance policy. He borrowed against it, and he made Disneyland a reality. It's a powerful example of how believing in your dreams and having a financial backup can make the impossible possible. Now, I don't know if you heard about Pampered Chef. Now, Doris Christopher had a recipe for success. She was a founder of Pepper Chef, and she started her company from a basement on a shoestring budget in 1980. When it came time to expand, she didn't go to a bank. She used her life insurance policy to fund the growth of her kitchen tool empire. It's a story of entrepreneurial spirit and using the resources you have to cook up something great. Now, more recent, who won the national championship? Michigan. The coach Jim Harbaugh, he scored with life insurance. Jim Harbaugh took a unique approach to his compensation package with the University of Michigan. Part of his deal includes a life insurance loan arrangement, showcasing a modern use of cash value life insurance in contract negotiation. It's a move that secures his family's future while offering financial benefits to both Harbaugh and the University of Michigan. So what he did is he got them to put $14 million into a life insurance policy, $2 million over 7 years. When he retires, he's going to get $1.4 million tax-free for the rest of his life. Now, we've all heard of McDonald's. Ray Kroc is the mastermind behind that. And when he began to expand, he used his life insurance as part of his financial strategy to grow the fast food chain into global giant that it is now. These stories aren't just about people who made it big, they're about the strategic use of financial tools to create opportunities to overcome challenges and to secure futures. Cash value life insurance, with its flexibility and growth potential, has been a secret weapon for many, from sports figures and presidents to entrepreneurs, entertainment moguls. It's a reminder that financial wisdom and a bit of creativity can go a long way in writing your own success story. So now we got to take control of our own future. The reality is we shouldn't let institutions have all the fun. You look at this picture here. This shows you that these banks have a lot of money into life insurance, and they're using life insurance as a financial tool. Now, by investing in cash value life insurance, we can grow our money tax deferred like BOLI, Bank on Life Insurance, is COLI. The cash value in these policies grows without being taxed, grow each year without being taxed, and they can compound and accelerate growth. You have access to cash value for personal needs, whether it's funding a child's education, investing in a business, or supplementing retirement income. The cash value can be borrowed against tax-free under current laws. So you can leave a tax-free legacy. Now, the death benefit, while not the primary focus here, is still a significant advantage, providing a tax-free inheritance to our beneficiaries. In essence, if banks and corporations can use life insurance to strengthen their financial standing and secure benefits for the employees, there's no reason why we as individuals can't adopt a similar strategy for our benefit, for our financial health and family's future. It's about shifting our perspective from seeing life insurance merely as a death benefit to recognizing its potential as a powerful tool for wealth accumulation and financial planning. So let's not leave all the benefits to the big players. Let's mimic what they do. Let's follow what they do. It's time to take a page from their book and make our money work for us in every way possible, just like they do. So now let's take a look at the 401k. Now, the birth of the 401k, the 401k plan was, as we know, it didn't start off with the fanfare you might expect for something that's become so pivotal, to American workers' retirement plan. In fact, its creation was almost accidental, a byproduct of the Revenue Act of 1978, which included a provision, section 401k, which is an IRS code, that allowed employees to avoid being taxed on deferred compensation. It wasn't until 1980 that the potential of this provision began to be realized. The man behind the plan, Ted Benna, the real game changer, came when a benefits consultant named Ted Benna noticed this obscure provision and saw its potential. In 1981, he designed the first 401k savings plan for his own employer, the Johnson Companies. Benna, his idea was simple yet revolutionary. It allowed employees to save for retirement on a tax-deferred basis through payroll deductions, with the option for employers to match a portion of their contributions. The original intent behind the 401k was to supplement traditional pensions, not replace them. It was seen as a way for workers to have more control over their retirement savings, offering flexibility that pension plans lack. The idea was to give employees a tax advantage way to put aside money of their earnings and invest in the stock market, bonds, mutual funds, or other investment vehicles, thereby growing their nest egg over time. The shift in retirement planning happened and started as a supplementary savings option, quickly became a primary retirement vehicle for many Americans. So as companies look to cut costs and reduce liabilities associated with traditional defined benefit pension plans, they began to shift the responsibility for retirement savings onto employees, offering 401k plans as the main or only option. This shift represented a fundamental change in how Americans save for retirement, moving from employer funded pensions to employee funded market dependent plans. This was a huge impact. Now, the adoption of the 401k plan had profound implications for retirement planning. It democratized access to tax advantage retirement savings, allowing workers at all income levels to participate. However, it was also introduced with new challenges, such as the need for individuals to make complex investment decisions and bear the risk associated with the market fluctuations. The reality today is that the 401k is a critical part of a retirement planning landscape, with millions of Americans relying on it for their future financial security. Yet the shift from pensions to 401ks has also sparked debates about retirement readiness, the adequacy of savings, and the role of employers in ensuring the financial well-being of their retirees. That's just a huge burden for them to bear. So now the history of the 401k is a fascinating journey from an overlooked tax code provision to a key component of American retirement planning. Its creation and evolution reflect broader economic and societal shifts, including changing attitudes towards retirement. Now, the role of employers and the responsibilities of individuals as we navigate our own retirement planning, understanding the origins and origins and intent of the 401k can help us make more informed decisions about our financial future. Now, let's break this down a little bit. Now, let's talk about why putting your retirement savings to a 401k sometimes feel like a bit like rolling the dice at a casino. Now, don't get me wrong, investing is a critical part of building wealth and securing a comfortable retirement. But when we start to peel back the layers on how most 401k plans operate, especially those heavily invested in the stock market, we got to ask ourselves the hard question. Imagine this, at the end of every month, you take the money you've been setting aside for retirement and you head on down to the casino to try and make it grow. Sounds risky, right? You wouldn't dream of it, because while you could hit the jackpot, there's also a very real chance that you could lose everything. Yet when we funnel our retirement savings into a 401k, they're tied up in the stock market. Aren't we essentially doing the same thing? It's a gamble. Here's the deal. The stock market is unpredictable. It's influenced by a number of different factors: economic indicators, corporate earnings reports, geopolitical events, and even investor sentiment. Money managers, those folks who decide where your 401k funds are invested, well, they're doing the best to navigate these waters. But let's be real, they don't have a crystal ball. They can't predict the market's ups and downs any more accurately than you or I can predict the next roll of the dice at the craps table. But we got to remember the house always wins, and just like the casinos, right? In the world of stock market and investing, the house always wins. Those money managers, the folks that we entrust with our hard-earned money, retirement savings, they get paid whether your 401k goes up or down. Their fees comes off the top, diminishing your returns right from the get-go. They're called brokers for a reason. And there's an old saying that I always say that's painfully true. If you keep giving them your money, you'll be broker. Right? Does it make sense? So does it make sense to gamble with your retirement savings, to put it at the mercy of the market swings and the decisions of fund managers who get their cut regardless of how well your investments perform? It's a question worth pondering deeply. But the question, is there a better way? Now, I'm not saying you should pull all of your money out of the stock. I'm not saying that and stuff it under your mattress. I'm not telling you to do that. Investing is still a powerful tool for growing your wealth over the long term, but it's crucial to approach it with eyes wide open, understanding the risk and seeking out strategies that can help mitigate those risks. Diversification, understanding your risk tolerance, and having a solid financial plan in place are key. The bottom line is your retirement savings are too important to leave to chance. Educating yourself, asking the tough questions, and maybe even seeking out trusted financial advisor. I think seeking out to find a trusted financial advisor to help guide your decisions can make all the difference. Remember, the goal is to retire comfortably, not to gamble away your future on the stock market's roulette wheel. Let's make sure we're making smart moves to secure that future. Here's something that's been bugging me for a while. It's about how from day one we've been coached into playing this long game with our money. So people are catching on, especially those with a bit to protect and grow. They're looking beyond the typical savings routes, eyeing something that packs a punch without the knockout risk of the stock market. Enter index universal life insurance, or IUL. It has the safety nets to make even the most cautious investor nod in approval, the flexibility to put in more as you grow, and protections that keep you sleeping sound at night. It's no wonder the smart money is moving here. Now let's break down why IUL is becoming the go-to for folks looking to make their money work smarter, not harder. The index universal life that is indexed, or the IUL, gives you the opportunity to experience some of the upsides of the stock market without the risk of losing money. There are a lot of options and fees to consider before buying an IUL policy. This type of life insurance ties your cash value to the stock market, so there is an opportunity for greater interest earnings than the traditional universal life or whole life policies. The IUL policy can be a great option for any savvy investor or savvy saver who wants flexibility combined with low risk. Now, we'll answer the questions I'm going to answer. Excuse me here. I'm trying to make sure I say this right. I'm going to answer the question that you're probably wanting to ask right now anyway, and that's, how does the IUL not lose money? That's a question we hear all the time. So the index universal life insurance is a permanent life insurance policy, and it lasts your entire life as long as the minimum premiums are paid. Instead of just a low interest cash value account, this type of policy's cash value account is tied to a stock market index or indices, such as the S&P 500. Now, in comparison, the cash value in traditional insurance compared to universal life insurance. Usually, the goal with an IUL policy is cash accumulation as opposed to having a high death benefit. So in this, we want to have a lower death benefit because it brings down costs. So for example, with the index universal life, I'm having a hard time talking today, folks. Sorry about that. So for an example, with the index life insurance policy, you will generally pay more premiums than are needed to cover the cost of the death benefit in the early years of the policy. As a result of these overpayments, a cash value account is funded and earns tax-deferred interest that is sufficient to cover the cost of your life. Insurance coverage in the latter years of the policy, Now, for example, you do not have to follow a rigid premium schedule with an index universal life plan. This is different from a whole life insurance plans, which require you to come up with established periodic premium payments for the policy to remain in force. You may also be able to skip one or more premium payments if your finances are tight or your IU policy's cash value account is sufficient to cover the cost of the plan. This flexibility plus the opportunity to earn significantly higher interest payments is what makes index universal life insurance so popular. So how does index universal life insurance work? When you pay a premium into your IUL, a portion of it is used to pay for the cost of life insurance and any applicable fees. The remainder of the premium is credited to the policy's cash value account. The cash value of the policy, which is tied to one or more equity indices, earns interest based on the performance of the equity index account, which is credited to the policy's cash value. So more importantly, the cash in your policy is not invested in the stock market. It's not invested in the stock market. This means that the cash is in your policy is not subject to market downturns like it would be if you were directly invested in the stock market. Moreover, policyholders can choose between a minimum guaranteed interest credit, or a choice of one or more indices, or both. Additionally, the policyholder can also decide the percentage of cash they want to earn a fixed interest and the percentage they want in the index accounts. The selected index, the key component in your IUL. Now, if the index increases during the month, then interest is added to the cash value and returns are credited back to the policyholder, either monthly or annually. Typically, it's annually. So, how does an IUL not lose money in the down market? You will select index options within your IUL policy that will determine the interest rate credited to your cash value account. Now, these index options are not directly invested in the stock market, so there's no risk of loss. Most of your money goes into a very safe bond fund investment. A small portion of your premium is used to purchase options on the market that you are selecting. If the market increases in value, the options are exercised and the earnings are credited to your policy. Now, if the market declines, the options are not exercised, no interest is credited to your policy. This is all done internally, so there's nothing for you to have to do. The same strategy happens every year. So eliminating the risk of losing money in a down market, typically the most exciting attribute of the index universal life policy. And this risk mitigation results from two very important facets contained in the IUL. The participation rate is what governs the amount of interest credited to your policy, and it receives based on the performance of the index or indices your cash account is linked to. Now, the participation rate, and I understand this, is determined by the insurer and is generally anywhere between 25% to 200 and something percent, let's say 235% or more. So if the gain of an equity account is 8% and your participation rate is 125%, your account would be credited with 125% of 8%, which will give you a 10% return. So to help reduce large swings in interest earnings, your IUL could have be subject to a cap and floor rates established by the insurance company. So the cap, it just represents the maximum amount of your interest your account can be credited on the performance of the index accounts you have selected. But there's also a floor, and the floor is the minimum amount that you can earn from the index accounts that you've selected. Now, since many insurers offer a floor rate of 0%, if your index accounts experience down market, your account will suffer no loss in cash value account. So some IUL policies, they have a floor of 1%, meaning that you're always going to have a positive no matter what the market does. Okay, you're never going to have a negative return. So the floor established in your policy is how your IUL would not lose money in a down market. Policy loans is where you can benefit from arbitrage and enjoy the beauty of uninterrupted compound interest all at once. So this isn't just about borrowing money, it's about strategically leveraging your assets to work in your favor, maximizing your financial growth without missing a beat. So just imagine you've been diligently paying into your IUL policy, building up a nice chunk of cash value based on the performance of a stock market index. Now you're sitting on a nice, decent amount of money that's growing tax deferred. Here comes a moment when you need some cash, maybe for your child's college tuition and down payment on the house, buy a car, to invest in business opportunity. Instead of liquidating your assets and potentially facing taxes or pulling out money and retirement accounts and dealing with penalties or having that lost opportunity cost, you decide to take a loan against your IUL policy's cash value. Now, taking this loan is straightforward. You're essentially asking the insurance company to give you a loan with your policy's cash value as collateral. There's no credit check, there's no qualifying, there's nothing. Money's going to go directly deposited into your account within 24 to 48 hours. What's great here is there's no lengthy approval process, no waiting period. You get access to your funds quickly and efficiently. Now, about paying back this loan, you've got options. You're not locked into a rigid repayment schedule. If you want, you can pay it back at your pace. If you don't pay it back, the loan amount plus interest will be deducted from the death benefit when you pass away. It's a flexible arrangement that allows you to manage your finances without the pressure of traditional loan structures. So let's break this down here now. The benefit from arbitrage and uninterrupted compound interest. Let's look at it with a real life example. So let's say if you have $100,000 in cash value in your IUL policy, you decide to make a $500,000 loan to help start a small business. The interest rate on your loan is 5%, but your IUL policy has been averaging, let's say, 8% return based on index. So here's what happens. So even if you've taken out 50,000, your entire $100,000 cash value continues to earn that 8% return. Meanwhile, you're paying 5% on your loan. So you're effectively getting 3% for borrowing money. So that's called arbitrage, because you profit on the borrowed amount of money because your money's growth rate outpaces the loan interest rate. This is money working smarter, not harder. You don't have lost opportunity costs. Uninterrupted compound interest, your $100,000 cash value isn't reduced by the loan, so it keeps growing based on the full amount. This means that you're still benefiting from compound interest on the entire cash value as if you never touched it. Over time, this uninterrupted compound can significantly increase your policy's value, enhancing your wealth building capacity. So by leveraging your IUL policy through a loan, you've managed to invest in your business without derailing your policy's growth. Your business takes off, and not only are you able to pay back the loan from the profits, but your policy's cash value has continued to grow thanks to the magic of uninterrupted compounding and the arbitrage effect. An IUL policy offers a unique opportunity to access cash when you need it while still allowing your money to grow. It's a powerful example of how flexible financial tools can provide liquidity and growth simultaneously without forcing you to choose between accessing your money and continuing its growth. So this strategy requires a good understanding of your financial goals and careful planning, but when executed well, it can be a game changer in managing and maximizing your wealth. Now, let me clarify a murky area that others have created. Now, when folks hear whole life insurance, there's a mix-up, a misunderstanding that I want to clear up today. See, whole life insurance isn't just a one-size-fits-all. There's a world of difference between a policy that's just sitting there and one that's structured to do some heavy lifting for your finances. We're talking about the difference between having something permanent versus something that truly works for you, building wealth over a whole life. Not just offering peace of mind after you're gone. So let's dive into what makes a dividend whole life insurance policy just insurance, not just insurance, but a smart move for your money. When we talk about a whole life insurance from a mutually owned company, we're talking about a policy that's not just there to pay out when you're no longer around. It's a financial tool designed to grow wealth. These companies are owned by the policyholders, not the external shareholders, which means any profits that they make are returned to the policyholders in the form of dividends. You also have the guaranteed rates. And let's talk about guaranteed rates and dividends. Now, one of the key features of these policies is the guaranteed rate of return on the cash value. This means your money is going to grow no matter what happens in the market. It's a slow and steady wins the race kind of deal. On top of that guaranteed rate, you can earn dividends. These are not guaranteed, but choosing a company that has a history of paying them out, especially ones that done so uninterrupted for over 100 years, is like betting on a winning horse, but you know is going to win. It's about stability and reliability. So the company matters. So opting for a company with a long track record of paying dividends is crucial because it shows that they've been through every kind of economic storm imaginable and came out strong. This isn't just about past performance, it's about the peace of mind, knowing that your policy is within institution that knows how to manage its resources and reward its policyholders even when times are tough. So structuring a policy with cash value in mind is very important. So when we talk about structuring the whole life policy for cash accumulation, we're putting the spotlight on growing your wealth and enjoying tax advantages. Yes, the death benefit is important. That's the icing on the cake, but the real substance is in how the policy can serve you during your lifetime. A properly structured policy has three main components: the base, the term, and the paid up addition. So the base, this is the foundation of your policy. It provides the guaranteed cash value growth and death benefit. Think of it as the steady, reliable part of your policy that's always working in the background. Term, some policies include term insurance component, which is essentially a cost-effective way to increase your overall death benefit coverage temporarily. It's like boosting your policy's protection power without significantly increasing your premiums. And then you have the paid up additions. This is where the magic happens for cash accumulation. This is the bank. Paid up additions are essentially many policies that increase both your cash value and death benefit. They're bought with dividends, which means they're fully paid for and start accumulating additional cash value and earning dividends themselves. Over time, this can significantly accelerate the growth of your policy's cash value. So each part has a role. So for someone looking to maximize their policy for wealth building, understanding these components is key. The base provides a solid foundation. The term offers additional temporary protection if needed, and the paid up additions turbocharge your policy's cash value growth and overall death benefit. It's a strategy that requires a bit of upfront planning and understanding, but when done right, it can be a powerful part of your financial arsenal. In essence, a dividend-paying whole life policy from a mutually owned company structured with cash value accumulation in mind is a robust tool for planning financial planning. It's not just about leaving something behind for your loved ones. It's about enhancing your financial flexibility and security during your lifetime. The death benefit is crucial, but the living benefits, cash accumulation, tax advantages, and the potential for dividends are what make these policies a game changer for those in the know. So let's get into something a little more crucial here, taking the worry out of retirement. As we hit the final stretch or even settle into our retirement years, there's this nagging question that won't let us rest easy. Will my money outlast me? It's a heavy thought, especially after years of grinding, saving up in your 401ks, IRAs, and the like. Despite having a good chunk saved up, the thought of running dry is a real scare. Let's not even start on the market's mood swings, making these things more tense. So what's the game plan for those looking to keep their financial future on lock? I'm here to talk about a strategy that's picking up steam, putting a part of those retirement funds into a fixed index annuity. We call that FIA, a fixed index annuity. As people start cruising into that retirement red zone, or even if they've already touched down into retirement, there's this looming question that keeps many up at night. Will my money outlast me? It's a valid concern, especially for those who've been diligently stashing away their hard-earned cash in 401ks, IRAs, and other qualified plans. The reality is, even with a substantial nest egg, the anxiety about financial longevity is real. The market's volatility doesn't help, and adding another layer of uncertainty to those golden years. So what's a solid game plan for those looking to secure their financial future? Let's talk about a strategy that's gaining traction, moving some of that retirement savings into a fixed index annuity. So a fixed index annuity is like a defensive lineman or offensive lineman protecting your retirement savings from the opposing teams, which is market volatility. So here's the deal. The fixed index annuities are designed to grow your savings by linking your returns to a market index like the Standard & Poor's 500. But with a significant advantage, your principal is protected. This is just like the IUL. This means if the market takes a dive, your initial investment stays safe. You won't lose a dime of your principal due to market downturns. No risk to principal. The beauty of a fixed index annuity lies in its ability to shield your money from risk while still offering the opportunity for growth. And unlike direct investments in the stock market, where your principal can fluctuate wildly with market conditions, an FIA provides a safety net. The fixed index annuity provides a safety net. Your money isn't directly invested in the market. Instead, it earns interest based on the market's performance up to a certain cap. Now, if the index goes up, hey, guess what? You get a share of those gains. However, if it goes down, hey, hallelujah, yes, welcome. You stay flat, no losses. Hooray! Tax-free transfer and growth. Look at this. For those sitting on sizable amounts of money in qualified plans like 401ks or IRAs, yeah, you're worried about the taxes and when you make a transition. But transitioning of this money into a FIA can be a smart move. This can often be done through a tax-free transfer, preserving the tax-deferred status of your savings while repositioning them into a vehicle that's built for stability and growth without direct market risk. You also can get guaranteed income for life. So that's one of the biggest standout features of the fixed index annuity is the option to elect a guaranteed income for life. This isn't just about drawing down your savings. It's about securing a steady, reliable income stream that you cannot outlive, thanks to something called mortality credits. In the world of life insurance and annuities, mortality credits are a bit like the secret sauce. They allow for the pooling of risk across many policyholders, which in turn supports the promise of lifelong income. The longer you live, the more you benefit, ensuring that you'll continue to receive income even if your account balance runs out. See, mortality credits, the longer you live, the more you get. Mortality credits is basically a unique figure of life insurance products and annuities that essentially reward you for living longer. They work because, like I said, they ensure pools the longevity risk across many individuals. Some will live longer than expected, and some won't. This pooling allows the insurer to pay out more to those who will live longer, supported by the premiums and surrender values of those who don't. It's a powerful mechanism that can provide peace of mind and financial security in retirement. For those nearing or in retirement, shifting focus from accumulation to preservation and income generation is crucial. A fixed index annuity offers a way to grow your savings with a buffer against market downturns, coupled with the option for a guaranteed income for life. It's about making sure your money is working for you in the most efficient way possible, minimizing risk and maximizing security. As you navigate these decisions, it's wise to consult with a financial professional who can tailor advice to your specific situation and goals, and ensuring that your retirement strategy is robust and resilient as you've envisioned your retirement years to be. So these financial tools work like the magical blackjack table with a properly structured whole life policy. If you win the hand, you get the money. If you lose the hand, you get to keep your money. So with a properly structured whole life policy, a IUL or fixed index annuity, your principal investment is protected. It's like placing a bet that you can't lose. Your money has the potential to grow, linked to market indexes or indices, but without the risk of losing your initial stake if the market dips. So why do we seek out these opportunities? Because in the grand casino of life, we all want to make financial moves that secure our future, protect our hard-earned money, and ensure steady growth over time. It's about playing the long game wisely and with confidence. So the real question isn't if you should start playing this game, but if you haven't started already by choosing these strategic financial products, you're not just hoping for a winning hand, you're securing a winning future. So as we navigate the path of financial planning together, remember, it's not just about making money, it's about making smart choices that protect and grow your money, your wealth over the long haul. Let's make those smart moves together. So your financial steps are simply this. As we conclude the journey through the realms of financial strategy and planning, it's crucial to take the insights we've garnered and transform them into actionable steps. Here's a summary of the foundational pillars that will guide you towards achieving financial freedom. We got wisdom in planning. Number one, start with solid foundation of knowledge and a well thought out financial plan. E, examine alternative, explore broad spectrum of investment options beyond traditional stocks and bonds. A, awareness. Be aware of pitfalls. Stay vigilant about the potential dangers in the financial landscape, such as excessive fees and debt traps. L, leverage. Leverage insurance products. Use life insurance products strategically to enhance your financial security and growth potential. T, transform thinking. Challenge conventional financial wisdom and tailor strategies that align within your unique goals. H, harness opportunities. Seize on the tactical use of financial instruments to anchor your financial future in stability and growth. Y, yield empowerment. Engage actively in your financial journey, emphasizing continuous learning and adaptation. So I'm here. My name is Carlos Millsap. Please feel free to contact me for any additional information. I'll be more than happy to help you navigate these turbulent waters.